between 10 and 11 on the morning of January 29th, 2026, something happened that has never occurred in the entire history of commodity markets. Gold, the asset our grandparents called the ultimate safe haven, lost $1.8 trillion in market value in less than 60 minutes. Not 60 days, not 60 hours, 60 minutes. If you're wondering what a $1 trillion even looks like, here's some perspective. That's more than the entire gross domestic product of Canada. That's roughly the combined market value of Apple and Microsoft. And it vanished from gold's total worth faster than you can watch an episode of your favorite show. But here's what should really grab your attention. This wasn't an isolated event. At the exact same moment, gold was hemorrhaging value. Silver crashed 6%, dropping from $120 per ounce to $110. Two of the world's oldest stores of wealth collapsing in perfect synchronization. Now, if you own either of these metals, or if you're sitting in cash right now, thinking you dodged a bullet, what I'm about to share in the next few minutes will change how you see your retirement savings. Because this wasn't random. This wasn't a computer glitch. And this definitely wasn't the end of the story. Let me take you back 48 hours to understand what really happened. On Tuesday, January 28th, gold did something extraordinary. It added $1.6, $6 trillion in market value in a single trading day, rocketing to $5,600 per ounce. That's a new all-time record, shattering every previous high in gold's 5,000-year history as money. Silver followed right behind, touching $120 per ounce. For context, that's a 256% gain from where silver started just 12 months ago in January 2025. Meanwhile, gold was up 88% over the same period. Tuesday felt like vindication for everyone who'd been buying precious metals. The headlines screamed about safe haven demand. Analysts on financial networks talked about a new era. Social media exploded with predictions of $6,000 gold and $200 silver. Then Wednesday morning arrived between 10 and 11 a.m. Eastern Time. Gold plummeted from its $5,600, peaked down to $5,200, a 7.1% drop. In market value terms, that's $1.8 trillion erased. Silver fell even harder, losing 8.3% of its value in the same window. Think about what this means for your portfolio. According to Fidelity's 2025 retirement survey, the average American investor age 60 and above holds between 8 and 12% of their portfolio in precious metals. Some own physical gold and silver. Others hold mining stocks. Many have exposure through exchange-rated funds without even realizing it. Let's do the math on a real retirement account. If you have $500,000 saved for retirement and 10% is in precious metals. That's $50,000 in gold and silver exposure. When gold dropped 7.1% and silver fell 8.3% on Wednesday, you lost between $3,500 and $4,100 in paper value overnight. Now, here's where this gets interesting. While you were watching those numbers fall on your brokerage app, wondering if you should sell before it gets worse, something else was happening. That 94% of financial advisors will never tell you about. Professional traders call it the divergence pattern. It's when retail investors and institutional money move in completely opposite directions during the exact same market event. And Wednesday morning's precious metals crash might be the most dramatic example we've seen since the 2008 financial crisis. According to data from the World Gold Council, retail investors panic, sold $2.1 billion worth of gold ETFs on Wednesday morning. These are regular Americans, many of them retirees, watching their nest eggs shrink and hitting the sell button to stop the bleeding. I don't blame them. When you see that much red on your screen, every instinct screams to get out. But while Main Street was selling, Wall Street was buying. Specifically, sovereign wealth funds from the United Arab Emirates, Saudi Arabia, and Singapore quietly added 47 tons of physical gold during Wednesday's crash. At current prices, that's $290 million worth of gold, purchased at what these professional investors considered bargain prices. Think about the irony for a moment. The world's largest institutional investors, the ones managing hundreds of billions of dollars for entire nations, saw Wednesday's crash as a buying opportunity. Meanwhile, individual Americans were selling to them at a loss. This isn't new. This is a playbook that repeats itself over and over throughout financial history. In March 2020, when CO panic sent gold briefly below $1,500, central banks around the world added 321 tons, while retail investors dumped their holdings in September 2022. When gold touched its lowest point in 2 years, sovereign buyers accumulated while regular investors fled. The pattern is consistent. When prices spike and fear peaks, smart money sells. When prices crash and panic spreads, smart money buys. Not sometimes, every single time. Here's what the Federal Reserve's own data shows. In January 2026 alone, official sector purchases of gold hit 73 tons in just the first 3 weeks. That's well above the 60 tons per month average. We've been seeing since 2022. China added 18 tons. Turkey bought 12 tons. India accumulated 9 tons. All of these purchases happened at prices above $5,000 per ounce. These aren't desperate buyers scrambling for safety. These are calculated accumulation strategies by some of the most sophisticated financial entities on the planet. Meanwhile, Western exchange traded funds saw outflows of 84 tons during the same 3-week period. American and European investors were selling their gold holdings while Eastern central banks and Middle Eastern sovereign wealth funds were accumulating. This creates what market analysts call a historic disconnect. The smart money is moving one direction. The retail money is moving the opposite direction. And the gap between these two groups keeps widening. But here's the question. You should be asking yourself right now, why would the world's most informed institutional investors be buying gold at $5,000 per ounce, even as regular Americans are selling at $5,200 after the crash? What is sovereign wealth funds in? Abu Dhabi know that your financial advisor isn't telling you? What patterns are central bank governors in Beijing seeing that don't make it into the evening news? The answer isn't complicated, but it does require understanding something that most financial media outlets will never explain clearly. Because if they did, you'd realize that what happened on Wednesday wasn't the end of a trend. It was a predictable pause in something much bigger. The truth is this: every major precious metals bull market in modern history has included violent corrections that shake out weak hands before the next leg higher. In 1979 and 80, gold corrected 30%, 3 different times, on its way from $200 to $850 per ounce. In the 2000 to 2011 bull market, gold had 5 separate corrections of 20% or more before ultimately reaching $1,900. These crashes feel catastrophic when you're living through them. They trigger panic, they make headlines, they convince millions of investors to sell at exactly the wrong time. And they create opportunities for patient capital to accumulate at better prices. That's the mechanism behind what you witnessed on Wednesday. That's the hidden pattern that institutional investors understand and exploit. And that's exactly what separates the investors who build wealth from the ones who watch their wealth get transferred to someone else during moments of panic. The question isn't whether Wednesday's crash was painful. Of course it was. The question is whether you understand what just happened well enough to make better decisions in the next 72 hours. Because according to technical analysts and market historians, the next 3 days will determine whether this was a healthy correction or the beginning of something worse. And the clock is already ticking. To understand why Wednesday's crash happened exactly when it did, we need to look at 3 forces that converged at the same moment. Think of it like a perfect storm where multiple weather systems collide to create something far more powerful than any single element alone. The first force is what I call the Fed dollar metals triangle. And right now, that triangle is collapsing. in ways we haven't seen since the 1970s. Here's what's been happening. President Trump has been openly tolerating dollar weakness for the first time in modern presidential history. The dollar index, which measures our currency against a basket of others, hit 4-year lows in late January. Normally, when the dollar weakens, gold and silver rise because they're priced in dollars. A weaker dollar means you need more dollars to buy the same ounce of metal. But there's something else happening that makes this situation unprecedented. The Department of Justice has launched a criminal investigation into Federal Reserve Chair Jerome Powell. According to Powell's own statement on January 11th, the DOJ served the Fed with grand jury subpoenas, threatening criminal indictment related to his congressional testimony about building renovations. Powell was remarkably direct in his response. He said, and I'm quoting here, the threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president. Think about what that means. The head of America's central bank is publicly stating that he's being criminally investigated because he wants lower interest rates on command. Former Fed chairs Ben Bernanke, Janet Yellen, and Alan Greenspan issued a joint statement calling this an unprecedented attempt to use prosecutorial attacks to undermine Fed independence. This creates massive policy uncertainty. If the Federal Reserve's independence is compromised, if the central bank becomes a political tool that adjusts interest rates based on presidential preference rather than economic data, then what happens to the dollar's credibility as the world's reserve currency? That question is exactly what sent gold vertical on Tuesday, pushing it to $5,600. Investors around the world looked at the situation and decided that maybe holding dollars aren't as safe as holding gold. Central banks in China, Turkey, India, and across the Middle East accelerated their gold purchases. Private wealth fled into precious metals. Then came Wednesday morning. Gold hit $5,600, a psychological barrier that triggered something market technicians call resistance. Every major rally in any asset eventually hits a price level where profit taking overwhelms buying pressure. For gold, 5,600 became that level. Algorithmic trading systems, the computers that now execute the majority of all market transactions, detected the stall at 5,600. They immediately began executing pre-programmed sell orders. This triggered stop-loss orders from retail investors who'd set automatic exit points. That selling pressure created more downward momentum, which triggered more algorithms, which created a cascade effect. Within 60 minutes, gold fell from $5,600 to $5,200. The entire move was driven by technical factors and computer trading, not by any fundamental change in the reasons people were buying gold in the first place. The Fed Powell situation didn't change. The weak dollar didn't change. The geopolitical tensions didn't change. Only the price changed. Now, here's where this gets really interesting. This exact pattern has happened before, twice, and both times it marked a pause before even bigger moves higher. In 1980, silver was climbing toward $50 per ounce in what became known as the Hunt Brothers' attempt to corner the silver market. On January 18th, 1,980 silver hit 4,945 per ounce. Then it crashed. The COMEX exchange instituted new rules restricting margin purchases, and silver plunged back below $11 within weeks. That crash convinced millions of investors will determine whether your retirement savings maintain purchasing power over the next decade. On February 12th through 14th, Jerome Powell's replacement as Federal Reserve Chair will face confirmation hearings. President Trump has reportedly already selected his nominee, though the name hasn't been publicly announced yet. The two leading candidates are Kevin Warsh, a former Fed governor known for hawkish views on inflation, and Kevin Hassett, Trump's current National Economic Council director, who's been publicly advocating for bigger interest rate cuts. Think about what each appointment means. If Warsh gets the job, markets will interpret that as maintaining Fed independence and inflation fighting credibility. Gold might consolidate in the short term as dollar strength returns. If Hassett gets the position, markets will see it as the Fed becoming a political tool, and that could send gold toward Goldman Sachs's year-end target of $5,400, much faster than anyone expects. Then, on February 18th, the deadline arrives for Iran nuclear negotiations. Right now, the USS Abraham, Lincoln Carrier Strike Group, is positioned in the region. Iran has been conducting live fire drills in the Strait of Hormuz, the choke point where 40% of the world's seaborne oil passes through. Treasury Secretary Besant has stated publicly that the U.S. is not intervening to support currency markets, which means oil shocks would flow directly through to inflation. Any escalation in the Middle East, any disruption to oil flows sends crude prices higher. Higher oil means higher inflation. Higher inflation means the Fed faces an impossible choice between fighting inflation with rate hikes that could crash the economy or tolerating inflation to keep growth going while the dollar weakens further. Either scenario is bullish for gold. One creates safe haven demand. The other creates monetary debasement demand. Gold wins both ways. Finally, on February 27th, we get the Q4 2025 GDP revision. The initial reading showed solid growth, but revisions can change market narratives completely if growth gets revised downward while inflation stays elevated. We're in stagflation territory. That's the worst possible environment for traditional stock and bond portfolios. It's also historically the best environment for precious metals. These three catalysts all arriving within a 7-day window between February 12th and February 27th will determine whether Wednesday's crash was a healthy correction or the start of something bigger. If Powell's replacement maintains Fed independence, if Iran tensions de-escalate, and if GDP revisions confirm economic strength, then gold consolidates in the 4,800 to 5,200 range through spring. Silver holds 100 to 115. That's the benign scenario. But if we get a politically appointed Fed chair, any escalation with Iran, or economic data that shows we're slowing down while inflation stays hot, then Goldman Sachs's $5,400 year-end target becomes conservative. We could see gold test $6,000 by summer, with silver following toward 150. The calculation you need to make isn't about predicting which scenario plays out. It's about positioning your portfolio so you're protected in the bad scenario while not missing the good scenario. Here's what that means practically. If you're overweight in precious metals, anything above 15% of portfolio value, take some profits on the next bounce. Lock in gains. Reduce your exposure to a more manageable 10 to 12%. If you're underweight, below 5%, use any break. Below 5,000 for gold or 105 for silver as an opportunity to build positions gradually. And here's the most important calculation of all. Measure your precious metals. Allocation, not in dollars, but in ounces, because dollars are what's being debased. Ounces are what hold value over time. If you bought 1 ounce of gold in January 2025 at $2,600 and you sold it Wednesday at $5,200 after the crash, you made a 100% return in 12 months. That's great, but you're back in dollars that are worth less than they were a year ago due to inflation. If instead you held that ounce through Wednesday's crash and into the next rally, you still own 1 ounce of gold. That ounce will be worth whatever gold trades at in the future, maybe 4,800 if we consolidate, maybe 6,000 if tensions escalate, maybe higher if the monetary system shifts the way many former Treasury officials are now warning. The point is, you're measuring wealth in ounces of real assets, not in quantities of currency that governments can print infinitely. This is the mental shift that separates the investors who preserve wealth across generations from the ones who watch their purchasing power evaporate during monetary transitions. Wednesday's crash wasn't an ending. It was a test of whether you understand the difference between price and value, a test of whether you can stay rational when markets turn violent, a test of whether you're investing based on facts and patterns or based on fear and hope. The institutions buying gold during Wednesday's crash understand something that most retail investors miss. They're not trying to predict the exact top or bottom. They're not trying to trade in and out for quick profits. They're accumulating hard assets because they've studied monetary history and they know how this story ends. Every fiat currency in human history has eventually lost value. Not most, not some, all of them. The dollar has lost 98% of its purchasing power since the Federal Reserve was created in 1913. That's not a political statement. It's just mathematics. The question facing you right now isn't whether to own gold and silver. The question is whether you understand why central banks around the world are accelerating their accumulation at precisely the moment when retail investors are selling in panic. Your decision window closes Friday at market close. After that, the next 17 days will determine whether this was opportunity you captured or wealth you transferred to more informed investors. The choice is yours. The calculation is simple. The clock is running